Hi everyone, welcome back to another episode of Stocks All Day with Dr. O'Day. Today is going to be a little bit different. I'm actually going to tell you how I manage and invest the majority of my money in my main portfolio using a Vanguard Roth IRA. And as always, this is my own personal investing. This is not meant to be investing advice. If you decide to follow these strategies, please note that you're doing so at your own risk, and I am not liable for any choices that you make. Investing is risky, and please make sure that you do all of the research before you actually decide to get into this stuff. That being said, please let me know if you have any questions. Please make sure to hit that like and subscribe, and let me know if there's any content that you would like to see coming up. And so this is something that I've been doing for about 5 years now at this point. And I've gotten pretty confident in this particular kind of investment strategy. So the way that I do this is I actually started out investing in a few different ETFs. So I had initially started investing in the Vanguard Total Stock Market ETF. That was about where half of my money was going. That's VTI for those of you that are familiar with it. I had about 25% of my money going into Vanguard's mid cap ETF. So that was the VO fund. It was a 20 to 25% going into that. I also had about 20% going into the all world excluding the US, the United States. I believe that's VEU was that fund. I also had a little bit of money going into small cap the Vanguard small cap ETF, and a little bit going into an emerging market fund ETF through Vanguard. I actually realized that I was making a lot of money on two of those and no money on three of those over the last 5 years. And so I decided to put my money where it was actually growing, and I've decided to pull back to just VTI, which is the Vanguard Total Stock Market, and Index Fund, and also the VO Fund, which is the Mid Cap ETF Fund. So I've got 75% in VTI, 25% in VO, and I try to maintain that balance as I continue to invest. So that's called rebalancing your portfolio if you aren't familiar with that. So I try to balance it so that it's always maintaining those percentages. So in 2016, so I've tracked this over time. So I updated it once a quarter. So once a quarter, I would get on, I would address things, I would rebalance my portfolio, I would invest new money. And the way that I started out was my wife and I were filling one Roth IRA at a time. So we started by just right off the bat, we said, okay, we have $5,500. Let's go ahead and start investing. And for everyone, the earlier you can start investing, the better, because compounding interest over time really adds up. The earlier you can get in, even if it's just $500, $200, $1,000, that's going to be worth a lot of money when you retire if you invest it in correct ways. Obviously, this is not investment advice, but all of you should start investing and start learning about the stock market. If nothing else, just learn and watch stock prices and things like that. But this is what I've done over the last 5 years in this particular portfolio. So I started with $5,500. Now, one of the best strategies that you can do in stock market when kind of planning for retirement is what's called dollar average investing. So the way the dollar average investing works is every quarter you invest the exact same amount of money. It's a specified amount and you don't deviate from that unless you put in a little bit extra. I mean, I don't think anyone would get mad if you put a little bit extra money in there. But the idea is that if the stock market takes a downturn, you still put in that money. If the stock market takes an upturn, you still put in that money. And you can do some reading on dollar cost average investing on your own as well. But the idea is that this kind of smooths out the market. It allows you to kind of take your emotions out of this. where if the stock market is down, you still invest that money and you aren't selling here. It's a buy and hold strategy, which is primarily what I'm interested in my main portfolio is a buy and hold strategy where, you start by just investing X amount each quarter. And the way that I figured this up, I did 1500 this first time because I was still trying to figure out exactly what my strategy was. But after that, I just divided this 5500 divided by 4. So each quarter that equates to 1375. So that's 1/4 of 5500. So every quarter I decided I was going to put a dollar cost average investment of 1375 in there. And that was just going to happen every quarter. I was going to sit down at my computer, I was going to look at my performance, I was going to put that amount of money in. However, I combine this with an arguably better strategy that's out there, which is value average investing. So value average investing, I love value average investing. It's not for everyone. It's a little bit difficult at times. You gotta have the guts to do value average investing because what this requires is that when the stock market's down, you put more money in. When the stock market's up, you put less money in. And so the way that this worked was I decided that I wanted to gain 3% every quarter. That would equate to about a 12% gain across the year. Obviously, with the compounding amount of that, it's actually a little bit more than 12%, but I decided that I wanted to gain 3% per quarter. And if I gained more than that, I would actually adjust this 1375 down because I actually gained more than 3%. And that means that potentially the stock market is a little bit overvalued and it's going to come back down to earth a little bit. And so by investing less, I take advantage of that upswing. I put a little bit less money in it, and then when it comes back down to earth, I lose less money on that potential downswing. Additionally, if things don't go so well in a particular quarter, I put more money in. So if the stock market falls 10%, I put this 1375 plus the amount that would bring me back to a 3% increase on the previous quarter, and that's how much money I invest. And what that does is allows me to take advantage of that upswing. It allows me to take advantage of the upswing. And so value cost average investing actually allows you to time the market without even thinking about it. And so the way that this works, so I started with 5,500. If that didn't make any sense, just follow along now. So I start with $5,500. And all of these columns have a very specific place in my portfolio. So at the end of this quarter, I sit down at my computer and I say, okay, my new total here was 5,500 because that's what I started with. My balance on 1-1-2017, my balance was $5,778.78. If I would have gotten a 3% increase on this 5,500, so what I did here was I took H2, which is 5,500 times 1.03, my account value would have been 56.65. And so we actually can look at these numbers. Did I do better than 3% that quarter or worse than 3% that quarter? I actually did better. So I did better than 3%. My money that I actually gained was 278.78. So that's this number minus this number. So we can see it's B3 minus H2. So that was the money that I actually gained. The percent that I actually gained was 5.07 across that quarter. So that is taking the money that I gained divided by my previous total, and we see that in that particular quarter I did better than 3%. I actually gained 5% in that particular quarter. I decided that my dollar average investment was going to be 1,500 this particular quarter. Again, I changed it to 1375. But now is where things get a little bit interesting. Rather than investing $1,500, I adjusted this $1,500. Because I gained more money than I actually really needed to or I wanted to, then that means that probably the stock market is a little bit overvalued. So rather than putting in the full 1,500, I adjusted that. And the way that I calculated this was I took the 1500 minus the balance minus the 3% increase. And so what this does is it says, okay, how am I going to adjust this based on the amount of money that I actually gained? I should have gained 5,665, but I actually gained a little bit more. I gained, let's see, that'd be, about $100 more. And so what's happening is I'm actually adjusting this $1,500 by a little bit over $100. So rather than investing 1,500, I actually invested 1386. So that brought my new total to 7165. So now let's track this one more time. So the next quarter, at the end of that, at the end of this 1-1 to 4-1 quarter, my balance was 74.99. Previous quarter, like it should have been at 73.79 if I would have gained 3%. So what happened was I actually gained a little bit more than 3% again. It was another good quarter here. And so the actual percent that I gained was 4.67% in this particular quarter. My dollar average investment would have been 1375. If you're following along here, what does this mean that I should do? So kind of take a second, maybe pause the video and look at this percent that I gained and see how should I adjust this number. Should I adjust it up or should I adjust it down? So pause the video here and think about that so that you can wrap your head around value average investing. So if you said that I should adjust this number down, you are absolutely correct. And so what I did was I took this number, this dollar average investment number, and I subtracted it. And so I took that number minus the difference between my actual balance and where my balance should have been, which told me that I should invest 1255.42. So I don't even have to think about this. The spreadsheet just does it all for me. All I have to do is once a quarter, I get on, I figure up exactly what my balance is, I type that number here. My spreadsheet then does some math. It says, okay, where should the balance have been? How much money did I actually gain? What percent did I actually gain? I type in my dollar average investment, and then it tells me what I need to invest this next quarter. It automatically does this for me. It is amazing that this spreadsheet, it just does it all for me. And then it'll tell me what my new total is. I double check that just to make sure everything checks out. And then we wait until the next quarter. And this takes me 5 minutes to do. I sit down at my computer, I type in, so I figure out exactly what the total value of my portfolio is. Actually, I have two portfolios, one for my wife, one for me, that I'm kind of managing together in this way, because when you're married, you can actually fill up two Roth IRAs. So, we've kind of transitioned into doing two Roth IRAs. And just as a heads up as well, Roth IRAs, now you're able to contribute $6,000 per year. It was that you could contribute $5,500 per year. So actually, if I were to divide that $6,000 up, it'd be $1,500 per quarter instead of $1,375 now. And so what we can see is that this 1375 number changes depending on the performance in the previous quarter. If I gain more in the previous quarter than 3%, then that number adjusts down. But if I actually gain less or I even lose money, then this number increases. And I will tell you now, this strategy is, again, not for everyone. The dollar average investment is a little bit more for the average person. But if you have the guts to stick with this, because sometimes you're going to have to put in a decent chunk of money all at once. And I'm going to draw your attention right here. In November and December of 2018, there was a fairly substantial drop in stock prices, and this sucked. So what happened was, in that particular quarter, I lost almost 14%. And that sucked. It was horrible. And actually, though, this was what I wanted. Because in order for value cost averaging to work, you need some downturns. You need stocks to fall. You want them to fall. And it's actually awesome when it happens. It sucks for everyone else that isn't adopting this strategy, especially those that are panic selling and things like that. But you're not a panic seller. I'm not a panic seller. Instead, I stuck to my guns. I said, okay, here's my dollar average investment. How am I going to adjust it? Well, I lost quite a bit of money right here, so this dollar cost average investment is going to go up a lot. I had to invest almost $5,000 in one quarter. This was a tough pill to swallow. And it does, like, you have to have the money in order to do this. Now, the kind of benefit here is that because I did this all at once, the next quarter I didn't need to put anything in. I actually, was able to sell some stuff. I actually could have taken that money out. And so, technically I would have taken this out. What I actually did was I left it in the Roth IRA because you don't want to pull money from the Roth IRA, but I still sold the stocks off, and I just made a note in this portfolio to me. I said, okay, there's 1327 of money that's sitting in my portfolio ready to be used. It's almost like it's in my bank account. And so actually this number, I didn't need to add any more from my bank hardly. I had to add about $170 from my bank to do this. So yes, I had to put in almost $5,000, but I didn't need to put any in for the next 2 quarters. And so stomaching that initially, if you have the money to do so, that's when you would want to put everything in. And again, value average investing allows you to time the market without thinking about it. It's not that you're watching the stock prices. It's not that you're constantly looking at these things and trying, because timing the market is hard. We'll see from my other portfolio if I can even do it effectively. But the vast majority of people can't time the market. But value average investing allows people to time the market without actually doing anything. When the stock market's down, you put in more money. And then when it comes back, that more money actually gains you higher returns, because then we saw that this thing bounced back 15, 16%. And if you take this amount, so 4,637. So $4,637 minus my actual money that I would have put in if I was just dollar average investing would have been $1,375. So I invested an extra $3,262 in that particular quarter. Now, let's think about this 15% increase that we had. This is a big return to normal. It's a big upswing, and typically that happens when the stock market declines. Eventually it comes back, and that's historically has been shown to do that. Now, if that's going to continue into the future, that's going to be something that you're going to have to wrestle with as an investor. I think that it probably will always continue to come back, and if it doesn't, in my opinion, we've got a lot more things to worry about than our particular retirement investment. Because if the stock market fully collapses and just gets destroyed, money's kind of going to become a strange kind of thing. So here, let's talk about, I invested 3,262 extra dollars that if all I was doing was dollar averaging, I would not have invested this money. The next quarter, there was a 15% increase. So I'm going to take that number times 0.15. There was a 15% increase. Because I stuck to my guns and I did this. So because I put that money in, I gained an extra almost $500 that I would not have otherwise gained. So if I would not have been value averaging, if I would have just been dollar average investing, I wouldn't have gained that extra money. $500 is a decent chunk of that particular portfolio. At the time, I had about 15 grand in that portfolio. So 500 divided by 15,000, divided by 15,000, I gained an extra 3%. 3% is a lot in a particular year. That year, I gained an extra 3% because of value averaging. That's huge. And because I've been doing this for now 5 years, my portfolio over time has averaged approximately, to date, my portfolio has averaged approximately 13.7% return on investment. And it's been great. I've actually, so here you might be wondering why I didn't put any money in. My wife and I moved, and I had a job for 1 year at Skidmore College. Our income actually went down because My wife was pregnant at the time and worked part-time for half of that year, and then was home working part-time as well from home in the spring with our daughter. So we didn't actually have money to contribute in that particular year, which kind of sucked because there was a big downturn with coronavirus. And can you imagine if I would have put in the money? If like that would have been amazing, that return on these investments. If I would have value averaged right there, so I mean, let's just do a little figuring. So I had 27,000 equals 27 296 times 0.76 because there was a 24% decrease. So my money went down to $20,744 from 27,000. If I would have value average invested there, if we would have had the money to do that, oh my goodness, can you even imagine? So I would have put in, no joke, I would have put in, so my portfolio should have been at 27 296 times 1.03. It should have been at 28,114. So I would have put in an extra, so I'm going to take that minus this 2744. I would have put in, if I could have stomached it and if I could have afforded it, I would have put in an extra $7,000. Now let's talk about the upswing. Over the next quarter, things came back 21.42%. So I'm going to take that times 1.2142. So I'm adding back in that gain right there. Actually, I'm gonna do that as I'm gonna take the 1 off of there. I would have gained an extra $1,500 if I would have value averaged during that time. This is, we want these things to happen. We want the downturns. And if you have extra money in your savings account, keep it in that savings account. Don't spend that money so that when these opportunities happen, you take advantage of it. $1,500. If we look at that, so 1,500 divided by 27,000, I would have gained an extra 6% this year. When you divide that across the last 5 years, that's an extra 1%. My gains, just if I could have value averaged during that time period, my gains would be 14.7% overall due to that extra percent. This is incredible. And it's just, looking at this, this is my particular strategy. It has worked great for me. I like thinking about stocks, so I'm actually transitioning currently. I'm starting this on the new year. I'm going to transition to doing this every single month instead of every 3 months because, what I'm going to start doing is my wife and I, we now have the money to fill 2 Roth IRAs with our savings each kind of year, and so that's going to amount to $12,000. So what you're going to kind of see is each month now, starting January 1st, 2021, every month I'm going to have my dollar average investment as $1,000, and I'm going to seek a 1% increase, and I'm going to adjust that up or down based on whether I actually hit that 1% increase. The other thing that I kind of do as well is each time I rebalance my portfolio. So you're going to see last quarter when I actually kind of like basically what I do is I type in what are my shares of VO, what does that amount to, what do my shares of VTI amount to. So let's say I got to the end of a particular quarter and my shares here equaled $7,000 and my shares here equaled $15,000. Well, it's out of balance. And so what I would do is I could sell a little bit here, but typically I can rebalance just by buying more because I'm investing $1,000 a month or 1375 every quarter. So usually I can just buy only VTI this particular month or this particular quarter, and that balances things out. Every now and then I have had to sell, but it's important that we keep these ideal percentages. The reason that you want those ideal percentages is that actually also allows you to time the market a little bit. So if VO is performing a little bit higher, if it's performing pretty darn well, by allotting some of that percent over to here, then you're going to take advantage of the upswings in VTI and miss the downswing coming back to normal of VO. So these are just ways that you time the market without timing the market. And I do this exact same thing with our daughter's college. So when we're investing for our daughter's college funding, I run the exact same spreadsheet, and I tell it to invest in these exact same things where I'm wanting a specific percentage to be in Vanguard's mid-cap ETF, specific percentage to be in Vanguard's total stock market ETF. And this just allows me over time to time the market a little bit, to continue to build a nice 3% or more increase per quarter. Again, my performance over the last 5 years has been approximately 13.7%. I've been very lucky. Obviously, all of this, you have to have the money in order to do this, but you can do this with any amount of money. So places like Robinhood allow you to buy fractional shares. If you don't quite have the money for a full share of something, I mean, I started out, I could barely afford full shares of things, and just get into it. I suggest to everyone that you get started as early as possible. This is how you build your fund for retirement. Compounding interest is amazing. You know, it's really great to see the build and what can happen to money over the course of 30, 40 years, etc. So with that, this is what I do in my portfolio. So that's what I have for today. I hope that you learned something or found this valuable. I really like sharing investment strategies, and I'm more than happy to answer any questions that you all have. Please let me know if you have them. Otherwise, have a great rest of your day. Please make sure to hit that like and subscribe to support the channel.